Okay, welcome. Let's try and analyze the market with our newfound tools in 2025. We made videos in 2020, 2021, 2022, 2023, 2024, and now we're going to make a 2025 stock choice selection for this summer. So you see over here, I'm just going to point, this is my watch list, and this is the graph. I'm just going to hold the phone in my hand. So this is the graph. And I got, what do I plot on the graph? This is TradingView. So the sites I use are TradingView to plot graphs and make a watch list. And then FinViz for screening and heat maps. Okay? They're both free. You can get a subscription if you want, but the free version is very inclusive. So I plot moving average, 25 and 100. That's it. 25 and SMA, EMA. So EMA means weighted and SMA means simple. So 100 is just simple and 25 is weighted towards the more recent days than the past. So 25 and 100 and volume. And that's it. So these lines are moving averages. Green is how do you know which one's wait? Green is 25, blue is 100. So the moving average is for blue is going up, and the moving average for green is kind of more volatile, crisscrossing a bunch of times. So when the moving averages crisscross, those are definitely good signs. Like here, it crisscrossed. The green started going up. The quicker one started going up, which means we got a new run of the blue one. Here, the quicker one crossed, started going down, which means the price stayed down for a while. Okay, here, the green was above the blue one the entire time, which means price went up for a long time. Here, the green one really got separated from the blue one, which means we were overextended. And we fell back down. Okay, so that's how you can use two moving averages to help you navigate your charts. What is this? This is the NASDAQ. Some sort of NASDAQ. It says 85 instead of 85 million, 8,500 or whatever. This is some sort of NASDAQ. I got some sort of S&P 500. This is the NASDAQ 100. Here I got boxes, like a box here, a box here, a box here. Just trying to whatever. Boxes go longer horizontal than longer vertical for the two indices, NASDAQ S&P 500, but not sequentially. Whatever, so I'm just trying to make some general predictions for how the NASDAQ and S&P 500 run. Now, the indices I look at are the small caps. So this is your IJR. This is your small cap. So small cap ETF. So these are the small companies are doing. Then I have MVV, which are the mid caps. How the middle companies are doing. So you see that's how they're doing. And then I look at so you see here at the bottom it says years. These are years. So this is very long term. But if you can also zoom in. I'm using this thing, not a mouse, so it's more difficult. But these are by years. So you can see the mid cap is like this. And the small cap, so the mid cap and the small cap are kind of almost the same. Let's look at the moving averages again. It went down here, it went up here. So is this the most recent? It's about to cross down, but the price is going up. So this is where we have divergence. So divergence means your indicator tells you one thing, but the price tells you something else. So that's how that means you got divergence, because the small moving average is about to cross the longer one on the way down, but the price is going up. So either price might also start bouncing off and going down, or the moving average might bounce up. But I think rather price will start going down. So price for these small caps might go down a bit. But the moving average is still very close to each other. Here it got overextended, but here they're close to each other. Okay. And then I got our S&P 500. Once again, I tried to predict more stuff with these boxes I drew and these Fibonacci traces to see how it's gonna, whether, see, it stays in this range, then it bounces into this range, then it hits resistance at the end of this range, so it might stay in this range some more, trying to get it back into this range. It's the S&P 500. And this is the correct one. See, it's the 1,000, 6,000, 5,700. My investing strategy right now is just to invest in these indexes because, you see, they always go up. They generate, 15 to 20% every 2 years, and then 1 year, negative 5%. So 1 year negative 5%, and then 2 years plus 20%, for an average of, say, 10 to 12% a year. But inflation is 3% a year. So on average, you make after inflation 7 or 8% a year with the S&P 500 or the NASDAQ. However, you're going to get 2 years of 20% and then 1 year of minus 5 to 10%. So 2 years up, 1 year down. 2 years up, 1 year down. If you invest in these. And what's good about that is they don't go up too much, they don't go down too much. So when you have a losing year, you're comfortable for two reasons. One reason is you know you're going to recover eventually, maybe the next year. And the second reason is you don't go down too much. So if your entire net worth, net savings is in these index funds, you're not going to crash more than ever 25% in a month or 5 to 10% in a whole year. Because it recovers very quickly. In a month, if a big crash, like a 25% crash, recovers very quickly. Why is that? Because the S&P 500 is the 500 biggest companies, and it gets refreshed. When new companies become big, they enter, and old companies leave. So it's always the best companies in the entire United States of America. So when they do well, you do well. So the NASDAQ is tech. So NASDAQ and the S&P 500 are both collection of stocks. They're not just one stock, they're a collection of stocks. So the chances of them all crashing are very much more diversified risk. So you're not going to all crash. You're going to crash a little bit, but they're not going to all jump as well. So you're going to go up a good 8 to 10% per year. And that's what I invest in, which is over here, the NASDAQ, the S&P 500, and you got weighted ones like this. So this just moves double what the index moves. So if the index goes up 1, this goes up 2. If the index goes down 1, this goes down 2. However, since we always go up in the long run, this gives you some extra weighted leverage to boost your portfolio. So this will go up 40% a year or down 15% a year. So you sprinkle a little bit. You put in maybe 20%, 30% of your money in the weighted index, and then 70, 80% of your money in the standard electronically traded funds of the indices. Now, for a little bit of fun, we can choose an individual stock. Now, the risk is they can go up 100% or 50% in 1 year. They can also go down 50% in 1 year. No matter which stock you pick, Apple, I use the biggest ones. Meta, Netflix, Google, Microsoft, Apple, Disney, Nvidia, Apple, I don't know what that is. Uber, Tesla, Blackstone. Okay, so I look at the biggest guys, and I might pick one stock, just one, to add that extra. Although remember, we are doing weighted ETFs as well, so weighted index funds are already you can do even triple weighted index fund. However, there's not that much liquidity in them because not a lot of people invest in those. So if you got a big portfolio or whatever, you might not be able to do it. But for small time retail investors, you can do a weighted index fund, and that's going to give you an extra double, triple movement. But we can also do individual stock as well. Not too many though, because it really, half of learning to invest is just a fucking process. It's a fucking process, meaning you just got to manage an account. You got to manage an account for 5 years, 10 years. And you got to get comfortable with when shit goes up and when shit goes down. When shit goes up, you got to start taking profits. And when shit goes down, you got to start reinvesting and not lose your cool. And not be constantly checking the markets, but also not get lazy. That's what it's all about. When you start to learn to handle your money, actually handle it, make trades, withdraw money, invest money, make selections, make decisions, ride out waves and swings, ride out times, read the news, political news, trade wars, recessions, real wars, and you actually feel your money working and or in trouble, then you learn to actually invest, because you can't just put in your life savings and say I'm going to invest. You got to start small and build up an appetite for it, So that's how you learn the actual skill and trade of personal investing, to actually have a stomach. Now I can invest $40,000 if I had it. But before I couldn't. I could only invest a couple of thousand. But now I've gotten so comfortable that I know what to expect and what to experience, that I can actually invest more of my savings into here. And actually, the reason I want to do that is because I have felt what success looks like, where I have made some good pocket change and supplemental income from investing, using my index funds technique and knowing that the market always likes to go up. So, however, when I started learning, I was going down. I had good years, bad years. But when you finally learn what it is or strategy you're doing, then, and you feel some success year after year, then you're comfortable with just putting in more money and getting more results. Now let's pick a stock. So we go start off NVIDIA. Boom. Oh man, I drew all this crap again. Here's NVIDIA. What do we look at? The price. Now, for the price, we do a logarithmic graph. So it means these are all correlated prices, which means they go by percentages and not by absolute value. So if you make it absolute value, this will be 500 and this will be 1. So it goes 1, 2, 1, 2, 1, 2, and then 500. But the new prices have to move a lot more to meet the same percentage returns. So that's why we use a logarithmic graph to see how percentage-wise the graph goes up and down. So the first thing I do when I look at my big companies to buy, because I only buy blue chip stocks, these big companies. I just had a big hamburger and French fries, sorry. So let's make, where's my data? Sorry, let me, okay, up here. Week. Let's do, what the fuck? Sorry, let me just change the date. I don't want to look at 27, 2026, 2025. I gotta look at much more recent. And unfortunately, it's not. Okay, here we go. Down here. Let's go with 6 months. Okay. So here I got June, May, April, March. Let's look at 1 year. Okay, here I got February, March, April, May, whatever. So this is NVIDIA. December 2025, when everyone thought of AI, is when it really went up. It's since crashed, but it's starting to go up again. Let's look at our moving average. Started to cross. NVIDIA's a buy. However, this level always seems to be resistance, so it seems to have a difficult time crossing this level. But the moving average generates strength. We would next look at some news on NVIDIA. Do I got anything down here? Beating all its earnings reports. Some dividends. This is the revenue and earnings. It is growing. That's a very good sign. Earnings not so much, but revenue growing. So revenue growing, but they had some cost issues, which is why they went down this year. They rated a strong buy. Strong buy. Analysts rated a strong buy. So NVIDIA might be a buy. And then how long would you hold it? Well, give it another, what is this? So give it another June, May, April. Give it for 3-4 months. So hold it for 3-4 months and take some profits. And boom, you've pocketed maybe 20-30%. If we go back some more, this level here is 140. Yeah, so it really exploded. This level was 50. So it was 50 in 2024. It was 50. And now it's it got a stock split, so it went up to like 1,000, but they split it. So now it's 150. So it tripled since 2024. Start of 2024. So about a year and a half, it tripled. But it had a little crashy crash. Competitors started hyping up their AI, but the technical indicator and the analysts say strong buy. Moving averages crossed, coming up to a resistance zone. But we had some good strength. We had some time to settle down, time to calm our nerves. And we might be starting a new up run. The next step would be looking at some news. Go to the company website. Go to the news around NVIDIA. See what the market is saying. What's the competition? What's the supply? What's the demand? What are some hurdles? Some obstacles? What does the macro political environment look like? And then you can invest and buy some stocks and hold for 3-4 months and make 25-30%. I might do that, but I might do that. So NVIDIA, and then you flag it. You put a little flag, and when the market opens tomorrow, whatever, you have a little flag. So here's Disney. Not good because never crosses this point. This is 113. And if I go back here, it was much higher. 120. And if I go back some more, it was even higher. So this stock is not really going up over time. You look at the moving average, it's always below. It's always going down. It's always below. It's always below. Oh wait, we had a very good time. Start of 2024, we had a good time. But then we went back down, we had a bad time. And then we had two overextended, so we're not going to go anywhere. Then we had a bad time because it was too overextended. And I don't know, Disney might be a good buy because we got some good steam crossing the moving averages, 25 over 100, 25 moving average over 100 moving average. However, we got this resistance, and in the long run, the stock's not up. But we might get it at a discount. So what do? We look at some Disney news. We look at the overall market. Are people starting to go to theme parks? Are people watching their movies? Are people buying their products? Are people subscribing to Disney Plus? What are their subscription numbers like? How many users do they have? Look at their CEO. What's their CEO saying? Is he running the company well? So Disney might also be a good buy because now let's look at this crap again. Beating all its earnings. Paying 20% dividends. What the fuck? 20% dividends? Oh, maybe that's why the stock didn't move, because they're paying. No, dividend is 0.83%. Small dividend. Revenue. So revenue and net income are growing. That's not bad. Revenue, net income are growing. That's not bad. What do analysts say? Analysts say buy. So Nvidia and Disney might also be good buys. What about Apple? Not just looking at the chart, not going to buy this crap. It's going down. Maybe wait till it starts going up again. Maybe it'll go up again over here in August. July, August. How long would we hold Disney for? Disney, maybe up to right here, at least until August, maybe September, October, September. So that's what you expect from Disney. Microsoft, looking like it's overextended. So July might get stuck. But the thing about Microsoft is, where's this market cap? Size of the company is $3.5 trillion. Biggest company in the world. $3.5 trillion. Look at Google. Oh, moving average is about to cross, but I don't want to buy it until they cross. Because it did drop. See, it dropped from here. 202 to 174. Now over here it was overextended, so you could buy it, but the problem is when it's overextended going down, it might only recover up to here and then go down even more. So you really want to only beware of the overextended on the upside and not overextended on the downside, because it could just keep shitting. So overextended on the upside, too high, goes down, you short sell it, and then wait till it crosses the moving average. So that's Google. So Microsoft and Apple, no. Disney, yeah. Nvidia, yeah. Google, maybe in end of June, start of July. You can buy it and see if it goes up. Then if it goes up, you can hold it all the way to November or whatever. Everything is about like 3-4 months. 3-4 months. Because with the individual stock, the strategy is to hold it 3-4 months, okay? If you hold the individual stock for a year, you're not going to profit. Because they see how they all swing around? They all swing around too much. So because they swing around, you got to make money when they go down. You got to make money when they go up. You got to ride the volatility. That's what it is. It's volatile. So you got to profit and you got to reinvest the dips. And that's how you can make money every 3-4 months off individual stocks. But if you just fucking wait 1 year, it's not going to work. You got to either wait 10 years if you like the company, but then that has nothing to do with the chart. That has nothing to do with the chart. You went into some private meeting and you met with the owners and you found out their strategies and you have trust and belief in them and you say, I'm going to invest in you for 10 years and you try to make 1,000% in 10 years or whatever. But if you look at some chart research, every 3-4 months, ride this wave. Ride this wave every 3-4 months. Meta, what the fuck happened here? Oh, Meta's maybe good. However, we're coming across to this resistance zone. So make sure wait till we cross that. If we cross it, maybe in July, and this blue line also starts going up, then we got blue and green going up, not overextended, and Meta is a buy. It's a market cap. $1.75 trillion. What's the chart look like for Meta? Aha. Pretty rock solid for Meta. Had a little bit of a crapper, so make sure we get out of this crap before we buy it. What do analysts say? Beating all its revenue and earnings. Had a little bit of a crapper in 2025. Ooh, revenue fell. That's a bad sign. So earnings, okay, they can fall, but revenue should not fall. So revenue fell. They're not putting enough penises on their ads in Facebook and Instagram. So revenue and earnings fell. And that's why we had the crapper. But let's see if they recover. So wait for another earnings report, see how it goes, and see if we recover, then you can invest in it. That's Meta. Then we got Netflix. We got Tesla, Uber, Blackstone. Okay. So basically, one of these was good, no? Uber, Tesla, Netflix. No, none of them. Meta. So remember, Google looking pretty good. So let's label these something special. Let's go with I'm gonna go with teal. What the fuck? More pop-ups. Please bring me more pop-ups. I don't have enough pop-ups. It's not 1996 anymore. I need more pop-ups. I need more 1996 pop-ups. Fuck off. What's this saying? Oh, I need to upgrade. I need to get a premium. I only get one color. Now this, ladies and gentlemen, is fucking marketing in 2025. We're not going to innovate. We're going to take stuff away. We're going to take fucking stuff away. It's like we got 2 flavors of chips in the store. If you become a premium member, you can buy the ketchup chips. If you become a basic member, a non-member, you can only buy the regular potato chips. It's the most dirtiest form of capitalism I've ever seen. I cannot change the fucking color. The fucking color. How pathetic is that? I get all these other features, not some sort of special indicators in the upgraded plan, not some sort of special forecasting and analyst reports in the upgraded plan. To change the fucking color. What else is it? Layout. So number of layouts I can have, number of indicators I can have, number of charts I can have. That's what you pay $1,000 a year for. So you can have more colors, more layouts, and more indicators. That's marketing, how to market your business in 2025. And it's like that for every single service app in the entire capitalism. So entire USA, London, and Canada. UK, Canada, and USA is all about restricting your freedom. Restricting your freedom. Not innovation, not usefulness, but changing the amount of fucking colors you have. Changing the amount of fucking colors you have. So, remember we found out Disney was... I don't know anymore. Yeah, whatever. Whoa. I don't know. Then which one do you like? Where are your emotions headed? Google. I might just go with Disney. I'm a Disney man. If we get past this zone, I might buy Disney. But I gotta hold it only for 3-4 months. I made a mistake by holding it too long last time, and I lost all my gains. So 3-4 months and then reset. 3-4 months and then reset. I'm gonna go with Disney. Okay. Hopefully we learned. We didn't use FinViz. We did all TradingView, but FinViz has some screeners, so you can screen. You can do a heat map, and remember just the time frames. So the time frames. 3 months, 6 months, a year, 2 year, 5 year, 10 year, whatever. Okay. So hopefully we learn some stuff, and then you can read the news on a different website, on a different app, make a portfolio, and happy investing. Cha cha cha.